Jim Cook here with a little update in regards to the recent market swings that we have seen. Now, for those of you that have been meeting with me regularly across the past year or two, you know that I was in the stance that we have a overheated market in at least certain sectors, if not overall, and that generally because of the drops that we've had post 2008 reversing themselves in equal to or less than the amount of time it took to get there, that we have not actually experienced a real market drop, one that would require a de-risking, if you will, of the environment in the stock market. And what happens is this creates a risk equals reward mindset, which is wrong. Risk is a probability of returns, and those that have a high chance of going up have also a high chance of going down. And we're feeling that right now, or at least seeing it in the stock market. Now, a couple things to note. For those of you with advisory accounts with me, you know that I put a certain piece into tactical investments. Tactical investments are investments that, using either a dial or a light switch method, will allow their internal holdings to functionally be engaged in risk with the market or to be disengaged with risk, depending on certain triggers. Now, I would anticipate that some of those triggers will be getting hit and on different pieces, as we've seen two rapid drops in the market in the last roughly 2 days at the time of filming this video. Can we see more? Absolutely. Because here's the reality. The market's only going to go one of three ways. It's going to go up, down, or sideways from here. That's it. And the reality is that if we do not need those funds, we already have a model in place for my advisory clients that is showing that we have different levels of protection across the board. And I say protection, what I mean, better way to say that would be wiggle. What's my wiggle expectations? The things that are nearest to when we need to spend them, the money, that wiggles less by default. The items that are further away may wiggle more. But just because the stock market is dropping doesn't mean necessarily that other investment tools or markets are dropping as well. Bond market, for example, may end up being more stable. Some foreign markets may end up being more stable. Who knows? This is crystal ball territory, and my crystal ball is as cloudy as the next guy's. But what I do know is this, is that with the process that we utilize for investing, the purpose is to focus on risk exposure all the time. So if the market was ripping and you were worried that you weren't getting as much, you're probably also not dropping as much right now. Doesn't mean over the last day or two that you might not have felt most of that drop. Oh, it could have happened because those are quick, short drops. And if we have a proverbial parachute on some of our investments, that may not have even been engaged yet. But in total, what do I think is going to play out as I look forward here? I think that in the end, the long scheme of tariffs is going to work like this. Both sides are going to ratchet things up. Things are going to get uncomfortable. They're uncomfortable. People complain a little bit. And then leaders are going to come together and say, let's hash out a new deal. They're going to figure out some lower number that's going to work. They're going to come back each side to their people and say, we did it. That's what's going to happen on that side of things. What's going to happen in the stock market? Well, outside of the who knows part of things, let's imagine that the stock market continues to drop. And let's pretend it drops more than what it did in 2022, which is what I think it's going to take in order to actually shake the risk people out of the tree, the people that think risk equals reward. Here's what I want you to look for. When you've got people throwing up their hands in exasperation, a sort of mental capitulation, a giving up, that is generally a sign that we have exhausted whatever kind of fall we have. Is it a guarantee? Of course not. Of course not. It's a general sign. However, we aren't anywhere close to that right now. So if you have a whole bunch of people saying, buy on the dip, and it keeps dipping like it did in 2008 or 2000 through 2003, well, then you have a spot to say like, well, market keeps going down. And remember, for my advisory clients that are invested with the model, like that has natural protections in it that should see you feeling less of the drop. It also, if this drop is focused more into, let's imagine, certain key technological players, may affect certain parts of the stock market more than it's affecting others. For instance, what if a company over here that was, I don't know, they're selling a widget and the widget sales were just fine and their stock price didn't really move? Okay, that's one thing. But if I had a tech company that had ramped up really high and is now ramping down quite a bit, that movement may be moving the market numbers more than what the rest of the companies actually do. We saw this in 2023 when only a handful of companies actually made it so it looked like the market was up and up quite a bit for a year. But the reality was that was not the norm. It was the problem with indexes, the problem with using this particular metric to determine your okayness. So I encourage you, if you have questions about your account or about how it's invested, reach out and set an appointment with me. Contact my assistant, Shelby Leonard. She is awesome, and she will schedule you so we can chat. Do not worry or work yourself up at all. 2, if you are in a spot where you do not have an advisory account, but perhaps have a commission account where it's a buy and hold philosophy over there, then I again encourage you, if you have questions, call, schedule an appointment with Shelby so we can talk about what the different paths are before you. It is not a requirement that you make any changes, but I will say that with proper planning and proper exposure to risk, we are still in a spot that if you look back, even with this pullback, which feels like it's really sharp, and we had 2 dramatic days, even with that, we are still at a net positive run. And people want the stock market to go up. So there is that inherent natural pressure, even if they panic at times and A, send it up too high, and B, make it go down too far. Now, for those of you that really know me, you know I get really excited and happy when the market drops like this. And you'd be like, Jim, I hate losing money. I'm like, I like buying on sale. And we've got a rebalance period coming up. And if it just so happens that everything is on a discount when we rebalance, like that is not a bad thing at all. If you're making regular contributions into your accounts and things happen to be at a discount, that is not a bad thing at all. So taking all that into consideration, ideally this video gives you a bit of peace of mind and reaffirms from a strategy standpoint what's going on. I am not one to subscribe to the media hype, and really what it is media anxiety factory that is out in play. And I look at rather we should be thinking about like actual facts, actual data, what's controllable, what's not controllable. Some people are like, what happens if we get into a recession? I'm like, fine. We haven't had winter for a bit, right? And winter is just a season like any other one when it comes to recessions, and what follows it is normally a longer growing season, period. It's the way it works. You say, well, Jim, I really needed this money and I'm panicking because it went down. If you really needed that money, then it shouldn't have been riding with such risk ahead of time. This is why we have conversations about risk tolerance a lot. This is why we set up layers of defense of accessible money to give you staying power for when things like this happen. And this is a blip, technically, even though it's extreme. And you'll see the media say S&P 500 boosted their largest drop in whatever historical period, or statements like this. The reality is they're just trying to get your eyeballs and your attention. And for me, I'm looking at things much more objectively. That's what a fiduciary responsibility is. And for my advisory accounts, that is what I'm required to and definitely have when it comes to looking out for your best interests. If you have any questions, give us a call, set up an appointment, let's talk. And if not, rest well and understand that what is unfolding around you is nearly a natural sequence of highs and lows across a longer period of time. Be well until we talk again. Take care.